Hello investors. In our previous videos, we have analyzed 8 small cap stocks so far which have announced stellar results. Today again, we have brought 4 new small cap stocks for you which have announced very good results. So in today's video, we will study the business models of these stocks. We will look at their results and we will also have a brief discussion on their valuations. But keep in mind, this video is in no way a buy or sell recommendation on any of these stocks. With this, let us begin. The first stock we will study is Yatharth Hospital and Trauma Care Services. You might have guessed from the name itself that Yatharth operates hospitals. So Yatharth has 5 hospitals in Jhansi, Faridabad, Delhi and Noida. Apart from this, they have recently acquired 2 new hospitals which will take their total bed capacity to more than 2300 hospital beds. Yatharth has posted very good results. If you look, their sales have increased by 31% in FY25 to reach 880 crore rupees. Their EBITDA has increased by 22% and net profit is up 14%. You might be noticing that this 14% profit growth is less than the 31% sales growth. And the simple reason for this is that the company is rapidly opening new hospitals. And when you are setting up hospitals, all the expenses have to be done in advance. The hospital has to be kept operational first. And then gradually over time, patients start coming and then sales and profits come. Apart from this, the occupancy rate, that is how many hospital beds are occupied, it has increased from 54% to 61%. Also, another important parameter, ARPOB or average revenue per occupied bed, which tells us how much the hospital is earning from each occupied bed, has increased from 28,570 rupees to 30,800 rupees. So directionally, a lot of things are happening good at Yatharth. Yatharth's ARPOB is lower than Fortis and Max because a significant number of patients of Yatharth come from the government's Ayushman Bharat insurance scheme. Now, talking about the long-term growth, Yatharth currently has 1,605 operational beds in 5 hospitals. Their 2 newly acquired hospitals with a total of 700 beds will become operational in Q1 FY26, that is between these April to June months, and their overall target is to take their total hospital bed count to 3,000 by FY28, which roughly translates into 23% CAGR volume growth for Yatharth. So Yatharth is a good fast growing business that you can review yourself. It is an asset heavy business, meaning a lot of investment is required upfront to acquire hospitals for expensive machines, doctor salaries, etc. Basically to get the hospital up and running. Because of this, there is always pressure on margins in the short term, but in the long term, it becomes a strong defensive business. Even the sector is showing very good growth. For example, India's hospital market is growing at 10 to 12% CAGR right now. But if I talk to you about only North India's hospital market, growth here is much higher, 12 to 14% CAGR growth. Apart from this, you might be aware that the cost of healthcare and treatment in India is quite low when we compare it to other countries. Because of this, people from abroad come here just for treatments, which is also known as medical tourism. So medical tourism is also a fast growing segment. And what's interesting is that around 45% of patients who come from abroad come only to Delhi NCR, and all of Yatharth's hospitals are located here. So Yatharth is benefiting from this as well. Now the risk with this business is that an IT raid happened on Yatharth back in 2023. Nothing wrong was found and there was no fine or penalty as such imposed on the company. However, some amount of money was seized during this period which Yatharth cannot use. And this case has been pending since then. Due to this, there is a bit of negative perception in the market regarding Yatharth. However, the management is saying that this income tax issue will be closed by this year, and maybe this can also be one of the reasons why the stock is currently undervalued. Now, the second business we will study is a unique business. Stock's name is V2 Retail and they run clothing stores just like Trends Zudio. The difference is that Zudio is mostly in metro and tier 1 cities, whereas V2 Retail is entirely focused on tier 2 and tier 3 cities. They have 2 factories in Noida and Bihar to design and manufacture clothes. So they sell both their own designs as well as clothes from other brands. In FY25, that is last year, they opened a total of 72 new stores, which has increased their total store count by 62%. Now they have 189 stores or roughly 190 stores across the country. Moving on to the results, they have been very good. If you look at this screenshot here, their sales have increased by 62% to 1885 crore rupees. Profit has grown even faster by 159%, reaching 72 crore rupees. Along with this, as the company is growing, profit margins are also improving. So that we can say the EBITDA margin has increased from 12.7% to 13.7% in 1 year, and the net profit margin has gone up from 2.4% to 3.8%. So we can say V2 Retail is a good high growth model. Their management understands the customers of small towns very, very well. They have built a very strong base in small towns, and now they are rapidly expanding their business model across the country. And among all these stocks, Trent, Style Bazaar, Vishal Megamart, V2 Retail, which together form what we call the value fashion retail segment. V2 Retail is currently the fastest growing business among all these stocks. Now, let's talk about the valuation and guidance provided by V2's management. So, their target this year is to open 100 new stores, thereby increasing their store count by 53% to 289 stores, or roughly 290 stores. Apart from this, the own label line item that you see here refers to their in-house design and manufacturing. Their plan is to increase the share of their own designs, which is currently at 40% of sales, to 55-60%. This will improve their margins because own manufactured clothes will bring higher margins, right? So talking about sales growth now, last year their revenue was 1885 crore rupees, which they plan to increase by 45% this year to more than 2700 crore rupees. As for margins, management has said that although margins will improve a bit, but since so many new stores are being opened at such a fast pace, we will not see any major margin expansion this year. Still, they are guiding for a 4 to 5% net profit margin. So the stock may look expensive to you based on FY25 profit, which is giving it a PE of 90. But since it is a growth stock, we need to look at the 1 year forward PE, and it is just 60, which is good for a retail business growing at 40 to 50% rate. Now you might feel that a PE of 60 for V2 is a bit too much high. Well, yes, it is a bit high, but retail businesses usually trade at high PE multiples only. For example, when Trent was growing at 50% rate, it was trading at above 230 PE, but then Trend sales growth rate fell from 50% to just 30%. So the stock derated and it corrected significantly. That's a different story altogether. But even now, it trades at a PE of 130. So what I intend to say is that businesses like Trent, DMart or V2 will always trade at premium P's. But anyways, that's also a risk at the same time, because if there is any issue in the growth even for 1 to 2 quarters, or if the results are not that good, then such growth stocks can also correct very quickly. And that's why tracking stocks is very, very important. Companies release their results every 3 months, and if you are a serious investor, then you need to keep tracking your portfolio stocks, like how are the results, is there any management change, has the CEO resigned suddenly. Similarly, sometimes companies start reporting good results all of a sudden. So likewise, that becomes an opportunity for investors. That's why we have created a personal WhatsApp community for serious investors, where we closely track more than 100 good quality stocks. We cover their business models, valuation, risk factors, how their profits and results have been, everything in detail. Here, I also share my own portfolio, and I am there for you to clear all your doubts on one-to-one level. But yes, we do not provide any buy or sell calls on any stock. We are not SEBI registered. My job, as I see it, is to only provide you with the correct and complete information on stocks. If you are interested, then you can send me a WhatsApp message on this number. Otherwise, we have also given a link in the description. You can message us using that link. And remember, this is a paid community with a monthly fee of just 850 rupees, meaning for just 850 rupees per month, you are getting to know about so many good quality stocks. And yes, there are two plans, 6,000 rupees for 6 months and 10,000 rupees for a full year plan. In the 6-month plan, your per month cost will be 1,000 rupees, and in the annual plan, your per month cost will be just 850 rupees. If you are interested, then you can contact us using the link below and you can join the community. And with this, let's get back to our businesses. Now, third business that we will discuss is EFC India. EFC is in the office leasing business. They take buildings on rent or lease, renovate them, and then they lease them further to other companies as offices. Now, it is possible that EFC leases an entire office or an entire floor to a single company. Apart from this, they also run co-working spaces. That is, in a big office, employees of different companies work together. So they also operate co-working spaces. This together is their rental business. They have 79 offices across 9 major cities like Delhi and Bangalore, where they manage more than 60,000 office seats, and per seat they charge around 6,500 to 7,000 rupees per month. Besides that, EFC also does interior designing for offices. They design offices for other companies, and currently they have an order book of 200 crore rupees in this segment. And recently, they have also acquired a furniture manufacturing company, which fits quite well into their both this office rental segment and their interior designing segment. Now, speaking of their clients, if you look here, you will see that many good companies or big companies like TCS, Tech Mahindra, Godrej, Flipkart, and Bajaj are their customers. So they also have a good client base. Let us move on to the results now. So you will see that the company's total sales have increased by 57% to 657 crore rupees. Their office rental business grew by 43%, and their office interior segment saw an excellent 133% growth. They are continuously adding more seating capacity in their office rental business. So we can expect good growth for this year as well. Additionally, the company's profit has increased by 122%, and EFC's net profit margin has also expanded. So you will see here from 15.1% to 21.4%. I'll not discuss too much on their furniture business as of now because that's quite small. Now, if you look on the right hand side, you will notice that EFC's 57% sales come from their office rental business, but it contributes to 71% of their profits, meaning that this is their high margin business, right? The interior business accounts for 40% of sales, and its share in profit is 28%, or we can say roughly 30%. So EFC is also a good fast growing business which you can study on your own. The valuation is also good. Currently, I think it is around 30 PE, and in India, the demand for flexible office spaces is also rising rapidly. So there are also industry tailwinds. But what is the risk here which you need to look at? So the quarter on quarter growth can be volatile for EFC. For example, if a new building is taken on lease, then that capacity comes in all at once. Or if a project in the interior designing segment gets delayed, then that sale will be appear or that sale will be recorded in the next quarter. And this quarter will show a lower growth rate. So you need to keep that in mind for EFC. The fourth and last business that we will study is my personal favorite, Sky Gold and Diamonds. Sky Gold is a B2B jewelry player, meaning it designs and manufactures jewelry for other jewelry retailers. As you can see here, nearly all famous retailers like Joy Alucas, Kalyan, Malabar, and even Carrot Lane, which is a brand of Titan, they are all customers of Sky Gold. Sky Gold has also announced very good results, and actually it has been part of my portfolio for the last 2 years, and it has consistently delivered very good results. So you can see here, their sales have doubled in just 1 year to 3,550 crore rupees almost, and their profit grew by 227%, or let us just say that it became more than 3x, reaching 133 crore rupees. And their net profit margin has been quite good too, around 3.7%. Earlier, they used to guide for just 3.5% net profit margin, but not only they have beaten that guidance this year, but they are also saying that they will take this 3.7% margin to 4.5%. Now, maybe to you, 3-4% margins might seem low, but in the jewelry business, profit margins are generally low only. Now, talking about the future growth and valuation, Sky Gold recently bought a land in Mumbai where they will be setting up a huge new manufacturing facility of 540,000 square feet. Just a year ago, they had moved into a new facility, but the growth has been so good that they have now decided to shift again into a larger factory. Their goal is to increase their current manufacturing capacity, which is at 1 ton of jewelry per month, to 4.5 tons per month by FY28 or so. This will drive strong sales growth in the long term. Besides that, in the next 2 years, they are targeting 7,600 crore rupees in sales, which means a solid 46% annualized growth for the company. And at 4.5% net profit margin, their estimated FY27 profit comes out to 340 crore rupees. If Sky Gold is able to achieve this, then it would be an excellent 60% profit growth, CAGR profit growth for the company. So although based on their last year's profit, Sky Gold is trading at a PE of 40-41, but if we look 2 years ahead, then PE comes down to just 16. So you can also study this business yourself once. It is available at very good valuations right now. Now, if you like this analysis, then do give me a thumbs up, and you can also subscribe to our channel Simpli Stocks, where we bring analysis of such multiple high quality stocks every week, that too free of cost. For us, these likes and subscribes are our only motivation so that we can continue bringing such videos to you for free. See you in the next video. Happy investing.